welcome. My name is Dawn Rickabaugh. This is your February issue of Property and Paper Live. I'm so glad to have you. This is where we talk about anything owner financing and notes. And today I invited a special guest to co-host with me to help answer questions. I'm going to pick his brain a little bit for all of us, but I want you to ask him questions. Be sure to keep yourself muted if you're not talking, just so we have a clean recording. And please use the chat button so that you can ask your questions. My trusty Axel that's always with me to help. Thanks so much. He's going to be watching for questions, and he'll jump in if I get going and I lose track. He'll help us stay on target. I think that's all of the housekeeping items. It seems like there's a lot going on in the world, and there always is going to be a lot going on, but I think it's important for us to just stay focused as much as we can. Of course, you guys know I'm a prepper freak, and I'm always telling you to buy extra food, buy extra water, and those things to be prepared for emergencies. If the power goes out for a little while or the internet goes down for a little while, just be sure that you and your family are okay. But for the most part, you kind of got to unplug and just figure out, what are you creating with your energy? What do you want to see? And focus on what you're creating and something you're passionate about, something that you love. And we all have different lives anyway, because we all create different worlds for ourselves. So let's just create the world that we want to live in. So, hey, someone's on their bike. That is so cool. Drew, that is so great. Movement. Yeah, here I am sitting in front of the computer. We're all sitting in front of the computer, and he's moving. That's fantastic. So, Nick, great. Michael, great to have you on. Adolf, wonderful, wonderful. So, did I miss anything, Axel, before we just head into talking with Shri?
No, I think you did well. Covered everything.
Okay. All right. Shri, so let's you have been hanging around the queendom here. You've dropped pearls and nuggets along the way for quite some time, before I went on my sabbatical and since. So I don't know if you have you can put your video on. Sure would love to see you. But oh, hi. Yeah, so just I just really have appreciated you and the value that you bring to the calls and your perspective. And I just want to ask you so tell us how you got started, and then and evolve us into what you're doing now.
Okay.
I'd appreciate that.
Yep. I got started in 2008 as a landlord, and pretty quickly figured out that I was just winging it. I didn't really take any formal training or never done landlording in my life before. I had a full-time IT job. I was working for Fannie Mae at that point in time, and I was in the division that was handling foreclosures, not I would rather say not handling it that great at that point in time. When I joined the team, there were a total of 6 people. When I joined the team in 2006, there were 6 people that was handling all the foreclosures that was coming in Fannie Mae. And we had to build out the whole team, the whole department, basically. And I got pretty well versed with handling different REOs, foreclosures, what happens after it becomes an REO, what happens if the bid price is not met, what do we do, win transaction of the property from the property perspective, note perspective, all of that. But I never figured that I could actually make a business out of it, because I never knew that there was something called note investing outside of what I was doing at my work. So
okay, so let me just interrupt. Do I understand this correctly? So you were working in IT. Well, at the time you were working in IT, you had started in 2008 to become a landlord, just winging it on your own, right?
Yes.
But you had an IT job with Fannie Mae. And so you're working with the foreclosure department of Fannie Mae back in 2008.
Yep.
And so you
It was
were
starting
there.
2006.
or 2006? Okay.
Yeah,
So you
yeah, I
you
mean,
kind of had this front seat to the breakdown at that time, to the big
yeah, that's why I
financial crash.
feel, yeah, I find surprising when people say Fannie Mae didn't know. That was not true. They were building the systems and teams starting 2006. They knew all along that this was coming. In 2006, they knew.
They knew that the crash was coming, but
I
nobody else
mean,
figured it out
none
till
of
2008.
yeah, none of the VPs or CEO told us, but they were building a team. I was just working, so I was thinking, okay, maybe they're planning for the future. But I didn't know this was going to get that big. Anyway, fast forward, I quickly figured out. I went to one of the conferences and we were meeting one of our clients over there. One of the clients needs to be just happens to be a New York stock guy that actually buys this MBS. So that was one of the conferences where they trade MBS, and he was telling what his other side of the business was, where what do they do after they buy the notes and all of that.
So you
And
said yes, mortgage-backed securities, correct? Just making
yeah,
sure
yeah,
that
yeah.
everybody.
Marcus, sorry. You
All
stop
right,
me,
yeah.
Don, because I'm pretty used to the acronyms. I keep using them. Please stop me
Right.
if I'm
Yeah, so
overdoing it.
basically, yeah, you're just talking about how do the institutions, move paper on the secondary market, right?
Yeah,
Versus
yeah, yeah.
owner carry paper, it's just mom and pops usually like us and a few bigger, funds and banks that are buying non-performing or performing usually or non-performing paper. But you're talking institutional. They're not doing that now so much, are they? Is that so?
I mean, the
Are they
performing
still
still
using
happens. So,
are they still securitizing them up in the same way they were back then when you're talking?
well, okay, this might take a whole hour, but
No,
um,
I'm sorry. Yeah.
so if you are trying to securitize an MBS, so let's take an easy example. Let's suppose you're creating a 1 million. I'm just using an easy math. The numbers are much bigger, but easy math. If you're creating a $1 million worth of, you're saying face value of that mortgage-backed security is 1 million, and it is securitized by 10 properties, each worth 100,000. Right? That makes sense. What happens is you have this security, the collateral for this security is this 10 properties, so you can derive different variables out of it and say that, what is the risk criteria based on all of that. So they start getting fancy and they start creating REMICs and different kinds of financial instruments. So what happens is, so each pool, when you create an MBS, there's something called a QCIP ID, so which is a unique identifier to identify what is that security, right?
Right.
That needs to tie back to a mortgage. They started creating so many different products in the middle, so you can't really trace back to which property is it actually, is the property performing or not. You can't trace it back. That it became so crazy that they created so many complex products in the middle, and they thought it was genius. I always thought, well, you don't know what is the collateral, whether it's performing or not.
Yeah. Yeah.
So there's something called swaps. What they do is when the net value of the whole QCIP has gone certain percentage, they swap out some of the loans to make the whole pool again whole. You know what I mean? Like out of 100, 10 loans have gone bad. The QCIP value has dropped at this point. It's, so what they do is they swap this 10 with some other performing note, right? Some of the 10 performing notes. You can only do swap as long as if the percentage of notes that are getting defaulted is less, you can keep doing that. At certain point, that game will not work. That's what happened basically in 2008. Because starting in 2006, they were keep on swapping it. Right. Anyway, so I met with a New York Stock Exchange guy in one of the mortgage-backed MBS conferences, and he was telling me what he does, how he was buying. I'm talking on pool basis. Yes, Victoria. So, so he was saying that he was buying, and we were having lunch, and they said you could buy it too. I'm like, I don't have billions of dollars. He said you don't need billions of dollars. Then I know I was struggling as a landlord at that point. I came up to 27 properties in Baltimore City, Section 8.
Oh, wow.
And I was self-managing with an IT job.
Wow.
So when I heard that, you can buy paper for yourself. So I met up with him after great difficulty. I was able to get an appointment, went to New York, drove up to New York, met up for lunch, and I asked, how can I get started? I said, I don't have time to teach you, but if you can when I get a pool of notes, you can buy a tranche from it. Tranche is nothing but a set of notes from the whole set, right? If there are 100 notes,
Right.
you can buy 10. And my staff is there. If you have any questions, you can ask. You can use our attorneys. You have to pay, of course, but my staff will help you. And her name was Cindy. I still remember her name. So she helped me out, and about 14 notes. I spent 175. You can't get 175 notes for 175K. You can't get 15. Back then, it was really cheap. These are all non-performing seconds behind performing first.
Got you. So you, I think I might have missed what you said a little bit, but you said you got 14 notes for your first tranche that you bought from Cindy.
Cindy was the person who was helping me, but she was working for that hedge fund guy.
Okay, so the hedge fund sold you a tranche of 14 notes, non-performing seconds, behind performing first for 175,000, and you were mentioning maybe that was a lot better price than you'd get today.
Oh, absolutely, absolutely.
Yeah.
I mean, you can you could buy Texas notes at 30 cents on the UPB, non-performing. Now people are paying 95 to 100.
Yeah, isn't that? I mean, that doesn't make sense to me. Does it make sense to you?
It depends. So I'll give an example. So I bought a note in, it's in Palmdale, California. She works for the city, the borrower. So she did not pay since 2008. The UPB is 145K. I bought it at 139.
139?
Right? Yeah, I bought it at 139K. The UPB is 145, but the payoff is 310.
Oh, because of all. Okay, but then in that case, that's like phenomenal because of the arrearages.
Yeah.
But then don't you have, okay, I'm sorry, but I want to, isn't the thing of you've gone too long. What is, I forget, it's escaping me right now. You're past the
Okay. So there is, you're talking about, you're talking about statute of limitations.
Yeah, that is it. Statute of limitations.
Yeah, the statute of limitations is very state dependent, right? Every state has a different rules. Like Illinois, it's 10 years. California, it's 10 years after maturity. So the loan hasn't matured. She hasn't paid since 2008, but the loan has not matured yet. Even now, it's not matured. Well, now it'll not mature because, I modified the loan. Recapitalized some of the interest and late fees, and brought it back into the UPB, and I created a new note, modified the note. So it depends. It depends on a lot of factors. When you buy a second, what is the equity position? What are they doing on the first? How is the borrower doing on? Well, if she doesn't agree for the loan, so what happens is, it might sound that, it's like a debt collector. It's not really like a debt collector. This is how the conversation goes. They get demand letters. Sometimes demand letter is the first letter that the attorney says that, hey, you owe this money, you got to pay by this date. If you have any questions, call on this number. And some borrowers call, hey, I totally forgot I had this loan. And I say, what would you like to do? Would you like to keep the property? If you want to keep the property, we'll work with you to see what is a payment that you can actually afford. Right? If you don't want to keep the property, or if you don't want to keep the property, instead of going through foreclosure, you can do a deed in lieu of foreclosure. So they can deed over the property to us. Okay. The other option is, I have enough equity in the property. I want to sell it, but I need time. Right. Then what we do is we take a minimum payment of, $500, whatever, forbearance period, where in temporary payment plan for 6 months, 9 months, however much they think it'll take for them to sell the property. Right. There are different options. There are 6 to 7 different options. You can buy the property in lieu and rent the property, or if the borrower has 2 homes, you can help them rent out the property. There are different options wherein, if possible, I try to avoid foreclosure 90% of the time.
Right.
There were instances where I foreclosed and deeded the property back to the borrower because they just didn't believe you could foreclose from second.
Say that again, because why?
Because they say you cannot, they believe that I cannot foreclose from the second position.
Oh, okay. Then you proved that you were right. And you sold
No,
it.
it's just part of the business. There's nothing to prove anything to anyone, but it's just part of the business.
Yeah.
Yeah, but anyway, so that's how I got started, and the seconds pricing started going up really crazy, and the product also dried down because most of the products that you see, I would say 90% of the product got used up since 2009 till COVID hit. So the product really, the pricing went up, the amount of product available, I'm talking about non-performing seconds, has gone down seriously. So starting 2017, I started buying non-performing first. Even that started going down. Then I started buying performing first, reperforming first, seller-financed paper. So now I'm buying seller-financed paper, obviously. I don't buy land notes. I
Gotcha.
did buy
Okay,
them.
so go ahead. What were you
I did
saying?
buy them, but I did not have good experience with land notes.
What, the land notes? Well, yeah, that was something, I guess a couple months ago, you came on the call because our guy Chuck that comes on the call lots of times,
Yep.
he was thinking about
Yep.
buying one of these land notes. And but anyway, so let me just recap just to make sure. So you started with the seconds, the pricing was great, there was plenty of product, then that dried up and the pricing got nuts, right? Too much competition. Those were the sweet, you in the beginning, people were just getting killer deals on those, right? But
Yep.
then
Yep.
pricing's too high, then the product dries up, right? There's not as much available. So then you go to, okay, I'll buy non-performing first then.
Mhm.
And then the pricing got crazy, product dried up, and then you just moved on to so now you'll pretty much buy about anything except not too excited about land notes. Did I get
Yeah,
that right?
that is
Right.
correct. That is
So
correct.
there's still a lot of people building funds up to buy big bunches, millions of dollars worth of non-performing. In your opinion, how are they getting pricing that makes sense to run, to buy in huge
Yeah,
bulk?
the product is available. I'm a small guy. My buy bucket is anywhere from 10 to 20 million. So that is, you cannot buy uh, like there are the hedge funds that you're talking about. The trades are going at 150, 200K, $200 million.
200 million.
So
Yeah.
yeah, so I mean, I know the guys that you're talking about. We did buy notes from them. They don't sell notes anymore, just because of the product availability. Yeah.
So
If
they're
I had
basically
200,
everything they're buying, they're keeping in house more and more.
yeah. So what they've done is they've expanded in-house staff, they expanded offices, they train folks, and they're keeping it mostly in-house.
Okay, so it's been harder to get a hold of. So
Yeah.
you say you're a small guy at 10 to 20 million. So I guess the note business been good to you. And I think you mentioned this before. Do you have a fund, or do you partner with other investors, or what is your
Yeah, I do.
what are you wanting to do going forward? Just keep buying for your own, or you're partnering with people? What's your goal?
I was about to start a fund, and the funds actually dried up. I mean, the availability of the notes dried up. So essentially, what I do is I have a bunch of investors that I, have worked with over years. Some of them even 10 years now. So they just keep reinvesting the capital they have, and
Right.
that keeps the funds in rotation, and they're happy that I'm paying them through the 10 years, never missed a payment. Um, So, there are different types of investors. Some prefer monthly payments. Some want a bigger share of the partnership, though, so they get once a year payments. Everyone has a 3-year lock-in period. What it means is once they invest, they have to wait for 3 years before they get the principal back. They get the interest and the profit share in the middle, depending on how we structure the deal. And at the end of the 3 years, they get the whole principal back, and they're running profit anyway all the way to 3 years, either monthly or quarterly or yearly. And at the end of 3 years, they
Gotcha.
get the principal back.
Gotcha. Well, cool. So I think before we end this call, I'm going to bring up the contact. So you guys just stick around and you'll get Shree's contact if you want to just check out what he has to offer. Basically, what I'm hearing is you've pretty much put on every hat there is, from being a landlord and the notes. You've kind of seen it all, because actually, unlike most people, you know, where I say to the average person getting started, like, okay, I don't know, I want to invest in notes, and I go, well, the easiest way is to carry paper on property you already own, right? That's super simple. But what you did is go from, you just went right into the weeds because of, I guess, your exposure, your connections at the time, someone that could sort of help you get access to them. I mean, to go from no notes to right into non-performing seconds, you know, that's a jump that's not the ordinary, I would say, for the average
So,
person. Do you agree or no?
I would say most of it is a lack of information. There's nothing special or magical about it. The reason I'm saying is, if you actually look at it, I'll tell you my perspective of why I think, I mean, not right now, but the pricing was good. Why seconds were better than first. I always say seconds come first. The reason is, I'll give an example. Let's suppose there's a property worth of $100,000. There's a 50K first lien, okay, 20K second lien, which you can buy for $3,000. Okay, who is responsible for taking care of the escrow? The first is performing, by the way. They're paying the first, and the taxes and insurance is escrow. You can verify by calling the first, right? What risk does the second have? You're buying $20,000 UPB. Payoff is, let's suppose, 25 or 30. You're buying it $4,000. So you are in second position. What risk do you have here?
Yeah, well, I get that point. Can you buy that same note for $3,000 today?
No. Now what happens is, most of the deals that I make is, I look for anywhere from 25 to 35% deal.
Say that again. Oh, you're looking for 25 to yield, is what you said.
25 to 35 yield.
Yield. Okay.
Yeah,
Gotcha.
but you know, I'm not buying 1C notes and 1C, 2C notes. I'm buying in bulk even now. And I'm not worried about, I'm not scared to buy some of the notes which are a little hairy. Like there's some title issue, you know, something was not recorded. The book and page number was not correct on some of them. So you had to put some elbow grease to get them fixed. Or working over a period of time. I mean, there are situations where the second was not paid off, but there is a title insurance was not paid off, but the property was sold to somebody else. So it becomes a title claim at that point of time, right? So you learn over a period of time. I mean, you can call it school of hard knocks or whatever you want to call it, but over a period of time, you learn this kind of stuff. It was not by design, but I just ran into issues over a period of time, and I started learning. You know, sometimes I got on your call. I discuss at least 4 or 5 deals on your calls before you went on sabbatical. You know, what's happening in the deal? What do I do? Sometimes I got the response that I was looking for. Sometimes I didn't get it. So you keep asking, you learn, keep learning, and keep moving. Best thing is if you have a good legal counsel. I mean, we buy in 42 states now. If you have good legal counsel, anyone can do this. Anyone can do this. If you have legal counsel and if you have good knowledge, anyone can do this.
Yeah, you have legal counsel in all 50 or all 42 states that you buy in, different people, or?
Absolutely. If not, how can you foreclose? I don't.
Yeah, but I mean, just guys that are on retainer or on your team or whatever. But you just mean when you need it.
I would say out of all the states, there might be 1 or 2 states where the attorneys were hard-nosed and they wanted a retainer. Generally, I do not pay a retainer. I tell them, you know, you want repeat business and you want because I have a Facebook group with 3,500 members. You know, a lot of people ask over there, hey, do you have an attorney in this state?
Right.
So I tell them, when I talk to a new attorney, you know, are you looking just for one and done? So you want a retainer, or you want me and other clients? What do you want?
Yeah, that's great. Do you run into, and if Axel, just keep me posted if I'm not paying attention to the chat, if there's other questions. So I'll just keep asking mine. you know, the statute of limitations is one thing. Okay, like but you know, sometimes a lot of times, especially in the early days, sometimes I would just do something instead of like analysis by paralysis. I would just like, I'm just going to do this thing and see how it works out. And so I bought a non-performing second in the state of Washington for like $5,000. I think the UPB was 25 grand. And I went to, you know, did all the things. Well, did you know Gordon Moss? I mean, he was the one that, yeah. I mean, to me, back in the day when I was the little younger of a note queen, note princess, maybe. Yeah, he taught me a lot. You know, the Southern California group was kind of where I kind of grew up down in there business wise. But anyway, I went to go to try to foreclose, and because I wasn't a licensed NMLS, they would not foreclose. They wouldn't start a foreclosure for me in Washington. So I just put it in the file saying, maybe someday he'll try to pay off or sell and I'll collect. So I just did that. So what do you say about that?
So what you're talking about is actually not an RMLO. To collect debt in some of the states, you need a debt collector's license, which is not
well, even to be the beneficiary on a note. It's not
you
even
need license
to try to collect service. It's just to own it.
Yeah, each state is different. Like California right now has a license requirement. I'm licensed in California to buy debt and collect on debt.
So you got your RMLO just to do that?
No, RMLO is originating the loans. This is debt collection or holding a note, be the note owner or the beneficiary on the note.
So and just being the beneficiary, you have to have a license?
Yes, in California, yes.
What is that? So, what are you calling that?
I can pull it up. 1 second. I mean, I apply, I get it. I didn't keep track of what exactly, because every state calls it different.
How many states are doing that now?
There are about 8 states that I have license. I don't know. Maryland is one of them. Ohio is one of them. Illinois is one of them. Georgia is one of them. Washington, California. There are a couple of more states. I have 6 of them right now, so I know this for sure. So a lot of people ask, okay, can I share my screen?
Yes.
1 second. You can see my browser, right?
It's coming up.
Yeah.
Okay. So if you type NMLS Consumer Access, this is the link. If you go in here, these are all the states. You can choose the state from here. So let's pick Washington that you're talking about. So these are all the different licenses that the Washington State provides to buy mortgage, right?
Okay, yeah, that's great. You know, since this is not my world, it was just like a random experiment. I just haven't paid attention, so this is fabulous. And then I guess there's the same kind of state.
Yeah, this one. So every state is different. Consumer loan company license. This is the one that I got to be able to buy mortgages in Washington State. So every state calls it different. Like this is for Washington, right? Let's go to California. So California has a different name. I mean, they will ask a little more documents. It might cost a little bit more, but you can get it done. And if you don't want to deal with it, you just want to get it, there's a company that does that for you, but they charge a lot.
Basically, they'll be your beneficiary placeholder?
No, they will not be. They'll get the license for you instead of, because they don't approve right away. They torture you. Like California, they tortured me for 1 year before they gave me the license. So
you said they torture you for 1 year. Oh man.
I think this is the one I got. Residential Mortgage Lending Act license. Yeah, this is the one that I
Oh,
got.
wow.
So name is different, but you have to read the description. That's where you know what to get. Anyway, so basically what happened to you in Washington is if you were actually Department of Financial Bureau, search for that Washington and tell them that, hey, I have only one. If that note is still in statute, I only have one note. I don't plan on buying any more notes. Can you give me exemption just for this note? They generally,
Oh,
they generally say yes. But if you do it on a repeated basis, obviously they're not going to do it. But if you ask them, just call them and tell you, hey, I just have one note. Can you exempt me? I'm not I don't buy notes regularly in Washington State. They'll let you pass.
oh, that's
You
really
get-
interesting.
Yeah.
Yeah, thanks for that. But if it's gone, I think it's 6 years. Do you have a tricky little NMLS or statute of limitations thing as well? Like this is in one website. Is there something like that for statute of limitations, or you have to?
No. Statute of limitations is a little tricky. So the statute of limitations is based on, it's not just like anything else. It's not standard for every state. So what I mean by that is, in some states, it's based on if the loan has matured. If it's matured from that date, like Florida, it's 5 years after maturity. California, it's 10 years after maturity. Illinois, it doesn't matter when the loan matured or if it has matured or not. It is based on when was the last payment made. So for a mortgage and a note, it's 10 years. If it's a HELOC, which most of the seconds are, it is 5 years from the last payment date. So every state is different. It's not.
Okay, so some will go, most go off the maturity. You want to unshare your screen so we can get back to the,
Yeah, sorry.
unless you have something else. But yeah, so basically, thank you for that, Shri. But
Yeah.
mostly it's within 5 to 10 years after the maturity date. In some cases, it's 5 to 10 years after the last payment made, and after which time it's uncollectible, or you won't prevail.
I don't want you to take a broad brush and just paint it like that. So if somebody has bought a note and if they're stuck, I'm available on Facebook. Just message me. They are buying the state.
Okay, what's your Facebook group?
Okay.
You should. Can you type it into the chat? Your Facebook group.
Yeah.
Note in real estate investing. Fantastic. Well, I want to go join Facebook group, and I hate Facebook, and I'll go to that.
What social media do you like?
None. That's not good for an entrepreneur. I'm going to have to repent and get my head.
So there's two ways, right? I use Facebook not to pass time or just comment on random stuff or watch cat videos. I use it for putting my word out and
right,
disclose what I do and help out. I mean, that's the reason I have 3,500 members in the group, because I help them sometimes for free against my own benefit. But I believe in giving, you get back much in return.
Yeah, well, thank you. I mean, someday maybe I'll be that cool. I just, what else are you seeing what's your opinion? I'll start with you, Shri, of what we're going to see for the market for 2024 and going into 2025. What's your crystal ball that you don't have, but like if you were going to have one, how are you positioning? What are you expecting? And what are your sweet spots?
I don't believe in predictions. Neither I do my predictions, but what I do is I'm a big believer of the data.
Data. Mm-hmm.
So there's Black Knight reports, Knight with a K, Black Knight data reports. They publish every month, and they publish how many loans are. I'm talking about residential, not commercial, right? How many loans are delinquent by 30 days, 60 days, 90 days. How many are in forbearance, and all every month, right? And I do a monthly webinar in my Facebook group. And I talk about this in detail because sometimes it's difficult to decipher what they're trying to do if you don't follow on a consistent basis. Because,
Right.
when COVID hit, it almost went up to 7.8 million loans which were delinquent, right? Right now, there are less than 350,000, okay? Just to give a comparison, back in 2011, there were 12.7 mortgages delinquent. Right now, there are 350.
Say that again. Make sure I got that.
Back in 2011, there were 12.7 mortgages which were delinquent. 12.7 million.
Million.
12,
Okay.
12.7 million.
12.
Right now, the number is less than 350K. I'm talking about 90 days or more. So you will see some of whenever a downturn is about to come up, you will see short sale gurus coming up out of the woodwork. You see that right now, and they're saying there are 2 million loans in default. You are well aware, Don, when there is a servicing change that occurs, generally it shows a false negative that they are delinquent. They're not delinquent, they're just not reported. So that 30 days delinquent, you can't trust the number, right? Again, it's just a servicing transfer issue most of the time. So they're not really 2 million. Yeah, 30 days late, they're 2 million, but actually it's more like 350, 400. That's the number which are delinquent. So based on anyone's knowledge right now, do you think there are more investors in 2008 or more investors now? The number.
Well, probably, I don't know, if 2008, because now it seems like they're putting everybody on these programs that it's forever. You own, but you don't. You're a slave owner.
What I'm trying to say is to draw a comparison between demand and supply back in 2008 versus now. There were lesser number of investors, more properties or more notes available in 2011. Now the number of, I'm not saying actual investors, but somebody takes a course and they think they're an investor. No disrespect, but it's the fact. So there are more investors right now than availability of product. The number of properties available. Right? That's the reason the pricing. That is the reason the pricing is going up and the product is really less right now. However, with that being said, the opportunity right now, which I thought was going to come into 2024 second quarter, sometime middle of the year, but I'm already seeing it, is in the commercial space. Office buildings, assisted living facilities, medical buildings. There was during COVID time, I saw a lot of motels, notes on motels, which are not performing. I don't see that anymore now. Maybe people are traveling again, and so they're being occupied pretty much. So I don't see defaulted notes on hotels and motels, but I see a lot of them on multifamily office buildings for sure. We have bid on some, we won some last year. So your question, what we'll be focusing on this year is if I can get my hands on notes on commercial property. That's what the target is.
Gotcha. Now, are you going to still get these from your hedge funds friends, or are you going to have to mom and pop pick these off in different ways?
I'm not biased to anyone. Whoever has product, I'll get it. But it might be difficult to get it from mom and pop for commercial. That's my assumption. I might be wrong. So.
More difficult from mom and pop than just when the banks need to dump, you can get a whole bunch at once, right? It's more efficient.
Yeah. I mean, there are two types of, one is a technical default, one is an actual default. Technical default is the loan has matured. You know what happened to the interest rates? A lot of multifamily was bought when the interest rate was sub 4 or 4. And now the interest rate have gone up, so they are paying the amount which was the payment which was applicable when the interest rate was 4. You know how this loans on apartments don't mature but reset after 5 years. Once they reset, they're not able to pay. So that is a product that's a technical default in the sense they're paying, but they're not paying to the adjusted rate, or the bank is not accepting the monthly payment, which was at the lower rate before the reset. So even banks are struggling. They don't know how to move them right now.
Right.
Office buildings, absolutely. One of my buddies here in Virginia actually bought Dallas Mall. It's by the Dallas airport. It was valued at some point of time at 237 million. He bought it for 49 million. The
Wow.
whole mall, Dallas Mall. So
What is it? But what's he gonna do with it?
So the benefit of that is the property is spread over 100 acres. Probably about 21 acres is where the mall is built. Everything else is parking area and vacant areas. So he wants to rezone it and build apartments there.
Build apartments. Wow. So it's basically almost a tear down.
Yeah. Yeah. I mean, I don't know what he's going to do with that. I think he was thinking about Amazon warehouse in the mall because Amazon. We are discussing all kinds of options. I don't own any part of it. I just helped in some of the due diligence part of it, but he owns them all now.
Yeah, that's something. Yeah, I mean, I guess so. That's so rich. Is there any other questions? Okay, more note investors. Yeah, there's lots of training because you know what?
Yeah.
In the old days when I was really still working as a nurse, raising all these babies, and on the weekends I was a weekend warrior. And I'd go to these conferences. How can I stop trading my time for dollars? Even though I liked my nursing job, I mean, it was kind of cool, right? ER, ICU. I mean, it was kind of, you always had cool stories, you know. I liked my job, but I'm like, I should be able to figure out how to quit trading my time for dollars. And then I fell in love with the note business. But back then, and that was we're talking late 90s to early 2000s, mid 90s to early 2000s, where I was going to these different conferences and things. And the note business always meant seller carry paper. That's what the note business meant. But then entree the big crash that we were just talking about. And ever since, 2008, 2009, the note business to most people now, because of all the education and the hype about it, and I can see why there's hype. You've done very well, you've illustrated, but all of a sudden people think the note business is buying non-performing paper from institutions. And I'm like, that was never the note business to me. It was just owner financing notes, one mom and pop to the other. So it's so interesting to see it. I've only bought a couple of, maybe a handful of non-performings but they were privately originated. And one was a second because the second was way bigger than the first. And so it made a lot more sense. And in some cases did really, really well. And in some cases broke even, never lost money yet, except for that one in Washington. I just thought,
Sure.
well, it'll come around sometime. But it's so great to have, I don't know, for me, my line in the sand is mom and pop stuff. And I haven't asked a bank for permission to do anything in over 25 years. And I like it that way. But there's a lot of people, you very well articulated, there's a lot of ways to play this game. And I really like that. Can I ask you a quick question?
Sure.
So I'm asking in particular, and I'm not going to take the time to describe the whole thing, but so in New Mexico, for instance, just to see what you'll say, there's property where, and it was kind of up in the mountains in Cloudcroft area. I don't know if you know the area. It's Allen. Anyway, so there was a reverse mortgage on that property, and then the lady died. And the reverse mortgage and the property had fallen into some disrepair, and it has been over 10 years now, and they've never called that note due. Are they now at the point, because I think she died in 2013 and now we're in 2024. Do they have the right to still decide they're going to wake up and foreclose on that property?
Absolutely.
They do.
Absolutely, because reverse mortgage is a different animal altogether. You know how reverse mortgage works, right? So they are
Well,
borrowing
yeah.
against your equity. So once the borrower dies, the borrower dies or the homeowner dies, the bank has the right to, foreclose, sell the property, and get their, whatever, you know, that
Yeah,
was the deal all along when once they got the reverse mortgage. It's not
yeah,
like a regular mortgage; it's exactly opposite because
well,
the
right.
bank is
So
giving
you,
money to the borrower.
right. Okay, so there's no statute of limitations like on a reverse mortgage. The funny thing is that the property value is even right now maybe 250,000. They have, I don't know if it was an
So,
error, but their
so
reverse mortgage is for, this was back in 20, it was like 495, two back to back 495. They almost have $1 million of reverse mortgage against a property worth 250 at the best.
I mean, they might have, so there are many options why the bank will not look at. So it's always like this, right? This was more applicable maybe 5, 7 years back. So I'm just giving a hypothetical example. Let's suppose you have 10 folks working in your non-performing department. You are a bank, and you have 10 people working, right? And you have 1,000 notes to work with, right? You have to dispose of 1,000 notes to still be a bank. If not, FDIC going to jump in and take all your assets and liabilities. This is your
Right,
situation.
right.
Okay. As a bank manager, VP of asset management, whatever, default asset management, whatever, your job is to see what are the assets that I can move as quickly as possible and where I'm going to get the maximum money. They're not going to lose money anyway because there's an insurance that is in place already, right? For the banks, when they write off any loans, they're not losing any money. Just so you know. What happens is when their taxes ratio drops below 10%, that's when the FDIC comes in and takes away. What that means is after the Great Depression and back in 20s, um, Federal Reserve came up with a concept of fractional reserve ratio. You know that, right? So what
Right.
that means is if you are licensed as a bank, if you have, I'm just using an hypothetical example, the ratios are different. If you have $10 in your bank, you can lend up to $100 because the 100 is going to come from the Fed. But you need to have $10 of liquid cash, right? 10% of liquid cash. The moment the 10% drops, FDIC jumps in. That's what happened with the Silicon Valley Bank, all of this, right? Although they had assets, every quarter when they review at that point of time, they didn't have 10% at that point of time. And when you have
Right.
3 quarters continuously where it drops below 10%, that's it. They come in, they don't care what your projectables or receivables or they don't look at any of that. They take away your license. Because what happens is in the Silicon Valley Bank is the investors panicked and they pulled all the money out of the bank right when FDIC was looking at the third quarter, and that's it. They pulled their license.
Yeah, well, don't you think there's going to be more bank failures? I heard a number just a few months ago, $80 billion left the traditional banking system. So don't you
Yeah, I
think
mean,
people are,
yeah.
a lot of institutions are teetering at this point?
I don't know about the same number of banks that failed in 2008. Most banks that have exposure to commercial assets, they will fail. Banks that have to residential debt, um, they might still do okay. Credit card debt is altogether a different animal because credit card debt is out of control right now. Student loan, everyone knows what's happening with student loans. So depends on what is their concentration, their loan portfolio, which concentration do they have in their portfolio. If they have more of commercial assets like multifamily office buildings, they're going to definitely get hit. There's no way around it. If they have residential more, they might still do okay.
Gotcha. Yeah, I mean, there was a deal that got brought to me that I really want, but I'm respecting the broker's right to keep working it on. But it's in my hometown, almost. Well, Carson City, right? It's only 55,000 people,
Right.
just south of Reno a little bit. And basically, this guy, the story of it was he bought the property. It's a commercial, I forget, it's a sort of warehouse slash a couple of offices I want to, it was fairly big. I can't even remember the square footage at this time. And I know exactly on the street where it is. I drive by there all the time. Well, he bought this owner carry back maybe 5 years ago uh, for $800,000 with, let's just call it almost half down. Yeah, like say it's $400,000 down, and then the sellers carried for him 400,000 at whatever terms. Well, he ended up defaulting on that, not making that payment, and so then he was getting foreclosed on. And then there was well, after digging around a little, a local attorney that must have been his buddy did all this work to create like this Wyoming LLC, going to a mailbox in Utah to hide the fact that he's right here in town. But he doesn't want to. So then he lent his money to get his buddy the money to avoid the foreclosure. And now the guy, it's past maturity and he doesn't want to foreclose on his buddy. So he's shopping the note. And then that got brought around to me on the around and through the back door, and I'm like, yeah, because I know the property and I'm right here, and the UPB, I think with arrears something like 376. And yeah, I bid that really, I don't know what the broker is going to try to take out of it, but I bid that pretty high. Like, hey, his initial investment, I think he gave him 350, and now it's the payables up to 376. And I'm saying, I'll give you your seed capital back, or even a little better, because it's making money at 12% secured by this property. And so there's a situation. I mean, what do you think of that? I mean, I want that deal, because at the worst of it, it's accruing interest in a really maybe 30% loan to value or less, investment to value or less.
Yeah. So is your intent to get the property or get the
No, I
return
don't.
on the
It's
note?
it's worth too much. I'll never own the property.
Okay.
It's
So
just a safe way to grow money. But the guy keeps promising that I'm selling something, I'm going to pay it off any day. Just give me a little more time. So we don't know what's going to happen. But
yeah,
what's
I
your
mean, most of the time, it's not bad intent. Borrowers have whenever they go into default, they don't have clear thinking. So you have to be sometimes a psychologist in a not an offending way to bring them to start paying again. So if that means starting the foreclosure, and I tell them when I talk to my borrowers, my intent is not to take away a home. In this case, it's we can say my intent is not to take away your property, but you need to start paying, right? We will work with whatever situation you have, but that doesn't mean if you don't pay, it's still going to work. No, it's not going to work. And generally, they wake up after they get the foreclosure notice. Notice of default, it's in the mail. That's when they act. As far as the numbers is concerned, if you're going to pay, so you said 375 was the UPB, right? Right. And when was the last payment made?
It was a straight note. So he's never made one installment. It was due in a balloon, because his friend said, I'm going to give you 6 months to get me paid off, but I'm going to save you from foreclosure. But the thing is, the property's probably worth maybe it could be worth up to 1.5 to 2 million right now. So even if it went to trustee sale, I'm only ever going to get what I'm legally owed. Someone will buy it.
Absolutely.
Yeah.
That is the reason I was saying, does it really make sense to buy it at UPB? Because, well, I mean, I just recently sold the property yesterday in Michigan. So, I mean, it's not a big note. The UPB was 59, the payoff was 59,000. UPB was 37. And I bid the top, I bought the note, the bar first wanted to work, then filed Chapter 7. Chapter 7 means it's saying, I don't have anything to do with the property, you can do whatever you want. Basically, that's what they said after they wasted my 5 months of time. I was working with them 5 months, then they did that. And I foreclosed on it yesterday, and 59,000, and the property sold 59,000. There is no overbid. Even if somebody overbids, I don't get the funds that goes to the borrowers or any other lien holders on the property. But I got 59,000 back. So What I want you to see is if you're buying it at UPB, calculate what the payoff is, and if if you're assuming that you get the full payoff minus the legal cost that you have, that number
Right.
still makes sense to you or not from an ROI perspective.
Yeah, no, there would be about a 30,000, it's only about a $30,000 discount, basically, is what because then, then it still makes sense because it's every month it's accruing at 12%. So then even if we got paid off, then hey, my investor partner made a solid 12%, and then I cover the legal fees. I don't know, there's enough of a spread, but just because it's local, that's something very different than if it was somewhere else. I don't know.
Yeah, if you're buying non-performing, I would definitely, because there are certain trends, right? Sometimes you have product availability in a certain market compared to others. It's not always the same states. Like during the downtown, Florida was a hot state where there are a lot of notes available. Not so much right now. So what I'm saying is, one of the reasons I got into notes was because I want to be location independent. As long as I'm getting a return, I'm a bank. I don't need to touch the house. I don't need to paint the walls. I don't need to change the carpet. Right? So I want to go where I can make the money. I mean, I was a residential note investor so far. I'm going into commercial now just because that's where the opportunity is. Does that mean there's a learning curve? Absolutely, there's a learning curve. But I'm prepared to learn it or partner with somebody, joint venture with somebody who has already done this, and do it, right? So
fantastic.
You can have a bread and butter business that actually, so for me, that's how I was able to quit my job in 2014. So I had my bread and butter and non-performing notes where non-performing seconds, I don't have to do much because at a certain point, I don't even give the borrower an option of discounted payout. Like if they owe 300,000, I bought the note for 150. I don't say, give me 200 and you're done, right? It's been only 2 months since I bought the note. I say only option available is loan mod. Right? I will agree to whatever you want, 3% loan, I'll give it. Because the reason is I don't plan on selling the note. I just want the cash flow so that I can support my lifestyle, right? So once I really quickly, since I started buying non-performing notes and when I quit my job was probably in 25 months. It was not long. I mean, more was it not because I didn't have enough cash flow, more was me being scared. Well, when will this stop? Because I didn't plan how this was going to work, right? And then I talked to people who were longer than me in this business, and they told me, plan for put a rainy day fund away, get at least two times more than what your monthly expenses are, and basic financial stuff, right? Once I got that, then I didn't have to worry about it. So now what happens is now I can venture into different aspects where the opportunities are because I don't have to struggle to pay my monthly bill or monthly expenses. I have more coming in than what's going out. So there was one more question. I want to make sure I get to it. The question was Dodd-Frank compliance. So Dodd-Frank compliance comes into picture when you are creating a note and the borrower, the would-be borrower, would be occupying the home as their primary residence. So the easiest way to be compliant is very easy. Hire an RMLO. It'll be probably like $800 to $1,200, and you can charge the borrower. Borrower pays that fee. It's very easy to be compliant, right? As long as the borrower has a social security number or an ITIN number, and they meet the debt to income ratio, you're good to go. You don't have to do anything. Once you collect all the information, what is that form called, Don? Once you fill out the mortgage application, is it 1090?
Yeah, the 1003.
Yeah, 1003. So download the 1003 form, ask the borrower to fill it out, and call the underwriter. Call the underwriter is one of the RMLOs that will do that for you. And if you need any specific state, give me a holler. I can pull out one from the database and give you that name. I think called underwriter does it in all states. So get the 1003, fill it out, and pass it on to the underwriter. and they'll pay the fees and they'll say whether they're qualified or not. Once
Yeah,
they
no.
qualify, that you're compliant. And make sure if you are keeping a note, if the borrower is a homeowner, board the loan with a licensed servicer in that state.
Yes.
Okay, there is a servicing company. I'm not going to name the servicing company. They are based out of Spokane, Washington. They have been servicing notes without being licensed in some states, and they got wrapped on their wrists. So to make sure that, again, the NMLS website that I showed you, that'll tell you if you're going to a servicer, if that servicer is licensed in that state or not. That NMLS website will tell you. On the website, you can go and check if that, put in the servicer name, it'll list out all the states they're licensed in. So just board with the servicer. It's $50, $15, $20. So
at the most, even with impounds, it's never usually more than 35. And in the old days, in the old days, like me, it was safe to do a little bit of self-servicing. Not so anymore. It's not safe to do your own servicing. It's not a good idea. Yeah. Hey, this has been such time has gone so fast, but we're already kind of over time. And so before we kind of sign off, I just want to thank you so much, Shri. And this has just been super valuable for me. And I hope that other people just enjoyed getting to tag along on our conversation, and maybe we will do this again. I am just right now going to bring up, if you're listening on YouTube or podcast, come on over and sign up at notequeen.com. Also, here is Shri's contact information that I have up on the screen right now. If you want to connect with him, and I will put this also in a blog post and below in the YouTube. So I really appreciate everybody showing up and participating. Always love seeing your faces. And then also I was just going to show you, I have this free on my site, notequeen.com under resources. This is just a really easy way to consume the information, access to the podcast, some free downloads for you. You don't even have to sign up for email if you don't want to, although I would love to have you participate. And then these are deep dives. This is the Property and Paper Summit recordings. And 2019, I just want to mention this before we leave, Tom Henderson, and he was one of he was such a funny speaker. He's one of the favorites for 2019. So go and watch Tom Henderson's YouTube video, that YouTube that I have of his presentation. And also I just wanted to give a shout out that he's doing his he's an old guy, the old timers, like one of the good oldies, and he's getting up there and he's doing his last live in-person training in San Antonio at the end of this month. So I'm going to be sending out, for anyone who's on my list, I'm going to send you out a link to that if you don't already know about it. Just want to give him a plug. He's a dear friend and just super smart and super funny. Even my kids, that didn't have a hard time following what I talk about sometimes, they just loved listening to Tom. So, all right, well, that is a wrap for today. And so go out there, create financial solutions, just one mom and pop to another. I'll see you next time. Thank you so much. Bye-bye.